All right, let's talk about something we've probably all felt. You see a stock you really believe in take a hit, and you think, is this my chance to get in? Well, today we're digging into a specific strategy for that exact moment, using the AI infrastructure company Applied Digital as our real-world example. This is the big question, right? It's the classic tightrope walk for any investor. How do you jump on a discount without getting caught in a free fall? The source material we're breaking down today offers a pretty fascinating, options-based way to think about this problem.
So first things first, before we get into the strategy, we've got to understand the company itself. We're talking about Applied Digital, ticker APLD. And, they've positioned themselves as a really key player in the whole AI infrastructure build-out that's happening right now.
Now, APLD's big claim to fame is that they build and run these things called AI superfactories. And look, forget what you think about a normal data center. These things are on another level. They're basically high-performance power plants specifically designed for the insane demands of the AI revolution.
So you got to understand their niche is super specific. They're not making the AI chips. They're building the custom-built high-tech homes that those chips need to live in. And their pivot from their old crypto hosting business to creating this critical infrastructure for chips like NVIDIA's H100s, well, that's the whole story right there.
Okay, so when you're playing in a hot space like AI, you're going to get some wild swings. It just comes with the territory. So let's take a look at APLD's recent stock chart to see exactly what kind of volatility we're talking about. Check this out. The stock builds this really solid base. Then, bam, it breaks out to new highs. Then the company comes out and reports fantastic, banger earnings. Everything's looking great. But what happens next? A classic sell the news event. People take profits, the stock pulls back from its highs, and that creates the very dip that this whole strategy is built around. So you're faced with this situation. A strong company you like, but it just had a pullback after great news. What do? Well, the material we're looking at lays out a really interesting options play to potentially take advantage of it.
It's called a cash-secured put. Let me break it down. Think of it like you're getting paid to set a lowball offer on a stock you already want to own. You're basically telling the market, hey, I'm more than willing to buy 100 shares of this company if it drops to X price. And for that promise, you have to pay me right now. It's a way to get paid while you wait.
Now, this is the really cool part. There are only two ways this can go. And both outcomes are pretty good. Scenario 1, the stock never drops to your price. Great, you just keep the cash you were paid and walk away. Scenario 2, the stock does dip, and you get to buy the shares you wanted all along, but at a discount to even your lowball offer, because you get to subtract the premium you already pocketed. Okay, enough with the theory. Let's get into the nitty-gritty. Let's look at the actual numbers of the trade that the source material proposed for APLD at the time.
So here's the setup. At the time, the stock was trading around $25.78. The play was to sell the $22 put option. Now, for taking on that obligation to buy, you'd collect a premium of about $1.05 per share right up front.
Now that first number, that almost 15%, that's your buffer. That is your cushion, your breathing room. It means the stock has to fall all that way from where it is now just to get to the price where you'd have to buy it. That's a pretty significant margin of safety.
And this second number, this is the real beauty of the strategy. Let's say the stock does fall, and you end up buying the shares. You don't just buy them at 22 bucks. Nope. Because you got paid that $1.05 premium up front, your actual cost basis, your net cost, drops all the way down to about $20.95. That's a massive discount from where the stock was trading. So you might be wondering, why $22? Why not 21 or 23? Was that number just pulled out of thin air? Absolutely not. According to the source, there was a very specific technical reason for choosing that exact level.
I just love this phrasing, a psychological fortress. The idea here is that 22 bucks isn't just some random line on a chart. It's the floor, the foundation, where the stock found major support before its last big run-up. By setting the strike price there, you're anchoring the trade to a zone where big money buyers have shown they're willing to step in.
Ultimately, what this is all about is finding a way to navigate that volatility. It's a strategy that turns that choppiness from something to fear into a potential opportunity. It's about managing risk by getting paid to wait for your price, all with that built-in safety net. And that kind of leaves us with the final question to think about, doesn't it? When the markets get crazy, what's the real risk? Acting or not acting at all?